can't make this up. Investors just lost $1.1 billion on Birkenstock's first day on the New York Stock Exchange.
Birkenstock closing lower in its first day of trading after pricing at the midpoint of its range.
$5 below the IPO price.
Hey, just the latest in a series of recent IPOs that have struggled. That is the focus of today's Tech Check.
Out of more than 300 U.S. IPOs of that size in the past century, only 9 have fared worse.
Ever wondered what happens when a 250-year-old shoemaker falls into the hands of a global private equity firm? Well, to understand how we got here, we first need to understand who was behind the Birkenstock IPO master plan, and how their decision to cash in billions of dollars in capital gains led to thousands of investors losing over $1 billion of their own money. Let's take a look at how we got here in the first place by understanding how private equity company Catterton came to own this German footwear icon. But first, who is Catterton? Catterton is a consumer-focused private equity firm backed by Bernard Arnault's LVMH, the largest luxury consumer conglomerate in the world. It's no surprise that this buyout firm has over $30 billion in assets under management and has previously invested in major consumer product companies such as Peloton and Build-A-Bear Workshop. In 2020, Birkenstock's owners had been exploring a sale for months with the help of bankers at Goldman Sachs, the world's leading investment bank, and this sale would be the first time the family-owned company would be owned by private equity since it was established in 1774.
Birkenstocks have been around since the 1700s?
1700s. They were first
they look like it, but I didn't know that was actually true.
So what was the sell? Birkenstock is a globally renowned German footwear brand specializing in the production of the now wildly popular footbed sandals. To uphold stringent quality standards, Birkenstock operates a vertically integrated manufacturing base, crafting all of its footbeds in Germany. Despite being an old brand, the company's products, lovingly referred to as Birks, have skyrocketed in popularity in recent years. You may have heard people finding them extremely comfortable and versatile to wear, but even environmentally conscious consumers have been impressed by the brand's environmentally conscious construction. Not to mention, a lot of hype has been generated by several celebrities wearing Birkenstocks, including Gigi Hadid, Leonardo DiCaprio, and Kendall Jenner. But at the end of the day, private equity firms invest in businesses because they think they can turn a tidy profit, and Birkenstock is no exception. In 2014, the Birkenstock family brought in its first outside management team, under the leadership of Oliver Reichert, first as a general manager in 2009, and then as the chief executive officer beginning in 2013, Birkenstocks transformed from a family-owned, production-oriented company into a global, professionally managed enterprise. This led to revenue growing from 292 million euros in 2014 to 728 million euros in 2020, representing an annual growth rate of 16%. What made this 2020 revenue result so impressive was that it was at the height of the coronavirus pandemic, a year in which many companies in the consumer sector suffered from poor performance. This result corresponded with almost 200 million euros of EBITDA, which represents the operating profit of the business. Given the announced deal valued Birkenstock at 4 billion euros, it's probably fair to assume that Catterton entered at a 15 to 20 times EV to EBITDA multiple. This may seem high, but there are 3 reasons why the sponsor may have been willing to pay this price. Firstly, there were strong reasons to believe that the company would be able to achieve strong, sustained, and profitable growth. Not only was market interest continuing to grow for the product, there was a clear path to pursuing growth in China and India, as well as expanding its e-commerce and direct-to-consumer business. With just over 3/4 of revenue coming from their flagship 5 products generating economies of scale, as well as consistent pricing power, there's a strong case that Birkenstock's profit margins would expand over time too. Secondly, we know that Catterton faced competition from other sponsors in the bidding process. CVC Capital Partners, another global private equity firm, had expressed interest in acquiring Birkenstock, as well as Primera Capital, which had recently listed another footwear business called Dr. Martens. As such, Catterton may have felt that a higher offer would be necessary to close the deal. Now, remember how we looked at Catterton's history and relationship with LVMH Group? This brings us to the third and final reason justifying their acquisition price. It's no secret that Bernard Arnault's LVMH Group is one of the most powerful fashion and luxury retail companies in the world. And it's very likely that Catterton would be able to bring their expertise and connections to supercharge growth in the business. And it would seem that this bet may have paid off thus far, with growth of the company skyrocketing to 31% per year since acquiring the business. But what happened next may surprise you. Birkenstock's debut in the US market didn't go too well. It's actually the worst opening for a company worth over $1 billion in New York in the past 2 years, according to the data. Out of the more than 300 big IPOs we've seen in the last century, only 9 have done worse than this. So what happened? Well, when Birkenstock shares hit the market on Wednesday, they were only valued at $41 each, even though they were initially sold at $46 during the IPO. It turns out that the offering price was lower than expected, falling below the midpoint range of $44 to $49 that was initially marketed. Birkenstock, along with its private equity owner Catterton, managed to sell around 32 million shares on Tuesday. The big players behind this offering were Goldman Sachs, JP Morgan Chase, and Morgan Stanley. With a long track record of consistent profitability, Birkenstock presented a unique IPO case where investors weren't buying into the hope of profits far into the future, but rather a chance to own part of a business already thriving at the bottom line. So why did the stock perform so poorly in its first few days as a listed entity? If we can't point the figure to the business's fundamentals, perhaps we can blame the high interest rate environment which has caused a broad drawdown in global markets. And the few companies who have forged ahead and become listed names this year, for example ARM Holdings and Klaviyo, have struggled since their listing dates. So in reality, while Birkenstock presented a strong fundamental investment case, it was joining this year's ranks of several other IPO hopefuls whose aspirations didn't quite match the reality of the current market. So, if everyone knew it was a tough market to go public in, why did the business choose to IPO this year? Catterton and the Birkenstock stakeholder base, which includes an experienced management team and significant influence from Bernard Arnault, are sophisticated owner-operators after all, and would have had plenty of listed market case studies to watch this year before pulling the trigger on their own exit. We'll never know the true answer, but we can take an educated guess. So let's dive into the rationale for Catterton to list Birkenstock in the current market. It's probably fair to guess that Catterton's decision to IPO the business could be categorized into 2 key questions. The first question is, what's best for Birkenstock? And the second is, what's best for Catterton? If we take a look from the lens of what's best for Birkenstock, 2 IPO rationales become pretty clear. Firstly, primary proceeds from an IPO would help to refine and reset Birkenstock's capital structure going forward. Based on financial statements provided in Birkenstock's IPO prospectus, total debt on the company's balance sheet increased by roughly 1.7 billion euros pre- and post-acquisition by Catterton. This is logical, as 2021 filings suggest that around 3.3 billion euros of Birkenstock equity was acquired at the time, indicating that Catterton financed just over half of the acquisition with debt, a very common ratio for private equity acquisitions. Around $500 million for debt paydown would reduce Birkenstock's current debt load, and therefore interest expense by around 25%. This would be attractive for the company and listed market investors going forward, as a lower debt load typically allows for more attractive future debt financing terms, and a lower interest expense increases the amount of earnings available to equity investors. Both of these things are good for the company because A, they provide a buffer in times of weaker performance, and B, they provide a more attractive return proposition for future equity investors. The second reason why an IPO was a good move for Birkenstock was that becoming a public company provides a newfound level of legitimacy. This newfound legitimacy can be exploited by the business in 2 key ways going forward. The first is that, along with a more conservative funding mix, becoming a listed company greatly enhances a business's ease of access to equity capital markets. This means that future equity raisings will gain increased investor attention and appetite, which creates an increased level of pricing tension for Birkenstock shares. The second benefit of increasing the business's legitimacy is that it further validates the brand on a global scale, which is crucial for the company as it embarks on its next step function in growth via expansion into the untapped Asian market. So it's pretty clear why an IPO this year made sense for Birkenstock, but now let's think about it from the lens of Catterton. If we sit in their seat for a moment and look at their ownership of the Birkenstock platform, 3 reasons for an IPO become clear. The first reason Catterton would prefer an IPO sooner rather than later is that a secondary stake sell down of around $1 billion, which is what was achieved in the IPO, would be significantly more difficult to achieve in private markets, and harder to use as a consistent vehicle for secondary sell downs going forward. The number of investors with a spare $1 billion in dry powder to acquire private minority stakes would likely dry up quickly, leaving Catterton with fewer and fewer available minority monetization options after each private market sell down. In a similar vein, Birkenstock's current valuation of around $9 billion at IPO is so large that only a handful of the world's biggest investment firms would ever be able to buy out 100% of the company. The second reason would be that an IPO allows Catterton to crystallize some strong portfolio returns in the midst of a weaker market backdrop. and likely weaker total portfolio performance. By capitalizing on the short-term trading performance of Birkenstock, Catterton can appease its investors with some strong returns in a difficult macro period. After all, an IPO at the $46 price implied a roughly 4.5 times paper money on money multiple. Catterton can appease its investors with some strong returns in a difficult macro period. The third reason for an IPO would be diversification. The IPO stake sell-down reduces Catterton's exposure to the footwear vertical, which is important because as a consumer-only investor, Catterton's portfolio diversification is especially sensitive to each consumer vertical it invests in, and can easily be overweighted into niche verticals. Catterton is an experienced, sophisticated consumer investor, and knows a thing or two about how to get the most value out of a well-known brand. So what were some of the levers they pulled to increase Birkenstock's valuation twofold over 2 years? Taking a look at the IPO prospectus, Catterton achieved 5 key financial and operational milestones in 2 years, which helped skyrocket Birkenstock's valuation. First, a 31% 2-year average revenue growth rate. Second, a 16% 2-year average growth rate in average sale pricing. Third, direct-to-consumer penetration increasing from 30% of revenues to 38% of revenues. Fourth, a 5% increase in gross profit margin to 60%. And finally, an 8% increase in adjusted operating profit margin to reach 35% in 2022. While Catterton didn't disclose exactly how they achieved each of these, they did credit their engineered distribution model that delivers the right product for the right channel at the right price point as the key driver for their success.
It really increased that much in value? Long story short, if you want to buy this stock after it comes public, you really gotta like this story plenty.
So to round this all out, how much does the IPO valuation imply as a return on Catterton's initial investment? Let's look at some simple numbers to get an idea of how much value they created within Birkenstock in just 2 years. Around $3.5 billion of Birkenstock equity was acquired in 2021, and Catterton financed around half of this with debt. At the IPO, Catterton made $1 billion from the sale of its shares. To add to this, their remaining unsold stake is valued at around $7 billion. This $8 billion total brings their total return to almost 5 times their initial $1.75 billion equity investment, a jaw-dropping return for only 2 years. In summary, the journey from Catterton's strategic acquisition of Birkenstock to its IPO has been a rollercoaster of strategic maneuvers and market challenges. Despite a stellar growth trajectory and successful financial engineering, the IPO faced unforeseen headwinds, underscoring the unpredictable nature of public markets. Catterton's decision to go public, driven by Birkenstock's capital needs and enhanced legitimacy, was met with market volatility, impacting the stock's debut. Nevertheless, Catterton's adept handling, coupled with key operational improvements, translated into impressive returns. We appreciate you joining us on this intriguing venture into the world of private equity, Birkenstock, and the ever-evolving landscape of consumer investments. Thanks for watching.